Welcome to Chapter 8. In this chapter, we're going to take a look at the various forms of business ownership that exist in Canada today. Once you've decided to start operating a business, one of the first things that you'll want to decide is, how am I going to be structured? What is the ownership structure going to look like? So this chapter will help you work through that and decide on what is the best form of business ownership for your business. In this chapter, we'll take a look at the three most common forms of businesses in forms of the type of business organization in Canada. Those are the sole proprietorship, the partnership, and the corporation. So we're going to take a look at what each of those are, as well as take a look at some of the advantages and disadvantages of those type of businesses. We'll also take a look at some of the other business structures that exist in Canada, and then we'll take a look at the different types of mergers and acquisition that exist in Canada and why they can be important to helping a company grow. One of the last concepts we'll look at in this chapter as well is franchising. Franchising has become a huge market, quickly growing, and we'll take a look at what franchising is, as well as some of the advantages and disadvantages and things to think about if you're looking at buying a franchise. And finally, we'll conclude the chapter with looking at some of the current trends. So in Canada, there are three primary forms of business organizations or business ownership: sole proprietorships, partnerships, and corporations. Each one of those will differ based on the types of financing that is used for each of those different types of businesses. So we'll take a look at what it may mean from a financing perspective. We'll take a look at what it may mean from an employee perspective. We'll spend some time chatting about what it means from a legal perspective, because that, in many cases, is the primary determinant of what form of business organization you might start up in Canada. If we take a look at some of the Statistics Canada data, we can see that by far there's a greater number of corporations in Canada. In fact, in 2008, corporations in Canada accounted for about 69% of the number of businesses and generated about 89% of the total revenues of businesses that are generated in Canada. Sole proprietorships was second, accounting for about 24% of the number of businesses, but a small percentage of the total revenues. By that, we can see most corporations tend to be larger businesses in Canada, and smaller businesses tend to be operated as sole proprietorships. And that makes sense, and we'll see why as we go through this chapter. Partnerships in Canada accounted for just over 4% of the number of businesses, generating about 5% of revenues. So corporations are by far the largest number of businesses that are operating in Canada, and there certainly has been a trend for many partnerships and sole proprietorships to incorporate as the business matures. And that is quite common. A lot of businesses will start up as a sole proprietorship. Sometimes they may evolve into a partnership, bringing in additional partners, and some businesses will then incorporate. I have noticed a trend towards incorporated businesses. Even individual farmers that have been running a business as either a sole proprietorship or as a partnership between husband and wife are now looking at the benefits of incorporating, and in fact are moving some of the assets and funneling the revenues and expenses through a corporation. And hopefully by the end of this chapter you'll be able to understand why that is happening. So before I go on and talk about the different forms of business organization, I want you to understand the concept of business liability, because that is one of the primary differences between sole proprietorships, partnerships, and corporations in Canada. When I talk about business liability, I'm talking about the legal obligation for a business to repay its debts. And those debts might be because of a court order, they might be because of the law, they might be obligations under the performance of a contract, it might be liability for all the debts of the partnership from creditors, it might be liability that's assessed by a court for damages caused by the business. So liability includes responsibility to pay any of those types of debts. And the liability of owners will differ between a sole proprietorship, a partnership, and an incorporated entity. So let's take a look at those three forms of business organization. The first is sole proprietorship. It is certainly the simplest form of business ownership or organization that is set up in Canada. And really, a sole proprietorship is really a business that's established, it's owned, operated, and usually financed by one person. So there's one owner. And that one owner decides to start a business. It's very easy. They register with the Government of Canada. They perhaps register a business name and get permits and that sort of thing, and hang out the shingle, and they're in business. So the sole proprietorship is very easy and inexpensive to form in Manitoba. And one of the advantages of a sole proprietorship is that all of the profits that are generated in the business go into the owner's pocket. So he has complete control over the company. He makes all the decisions. The owner makes all the decisions and is entitled to receive any of the profits that go to the owner. Of course, a disadvantage is that if there are any losses that are generated by the business, those losses are the responsibility of the sole owner as well. Sole proprietorships do not have the same reporting requirements that do exist for corporations. So there's not as many regulations, and we'll see a little bit later on that corporations do have a number of regulations that they must comply with. One of the advantages of a sole proprietorship is because the business and the owner are one and the same, there's no special taxation for the business. In fact, sole proprietors will file their regular personal income tax return and have a schedule of business income and expenses that is attached to their personal tax return. And so essentially, all of the business profits are taxed at personal tax rates in Canada. So there is no separation from a taxation point of view between the business and the individual, which can be an advantage. Sometimes this allows for some extra tax write-offs, home use of expenses, some business travel and that sort of thing. So there can be some small tax advantages by having the income taxed as a personal at the personal rates. A sole proprietorship is easy to dissolve. You decide to close your business, you make the decision, you close your business, satisfy your creditors, and take what's left over. So it's fairly simple to close a business as a sole proprietor. One of the biggest disadvantages of a sole proprietorship is that the one owner has unlimited liability, so they are responsible for all the debts of the corporation, all the debts of the business. So if there are any creditors or banks or lawsuits, against the business, that owner is responsible for all of them. He's also responsible for them personally. So if there is a judgment or a court order to pay for a lawsuit, it's not just the business assets that are at risk, but potentially personal assets could be at risk as well. So that's one of the biggest disadvantages of a sole proprietorship. And that is one of the main reasons why many sole proprietorships today are incorporating, because as we'll see, in an incorporation, there's a complete separation of the liability of the business and the owners. Sole proprietorships, because they're owned by one individual, sometimes have difficulty in raising capital, because the capital, or the initial financing that goes into the business, is generally brought in by one person. That person might be able to get personal loans or bank loans and that sort of thing, but there really is one individual that is responsible for financing the business. So if the business is looking at growing rapidly, needs a large amount of capital, it can be very difficult for a sole owner to raise that capital to expand. Another disadvantage of the sole proprietorship is because there's one individual that's the owner and operator of the business. Sometimes they may have limited experience. I've seen some sole proprietorships that have great innovation, develop great products. They have an incredible ability to sell their product, but they may lack some of the production techniques. They may lack some of the accounting that is required to operate a business. They may lack some of the human resource management to manage their employees. And so for a sole proprietorship to be really successful, they must understand where their weaknesses are and hopefully hire employees to be able to supplement their weaknesses. But one owner, they really are bringing to the table all of their experience and may have some gaps in operating all facets of the business. Because sole proprietorships tend to be smaller businesses, sometimes they have trouble finding and retaining good employees. You yourself, as you're graduating, you're probably thinking about working for large corporations that have a lot of benefits and frills and prestige, and often those things don't exist with a sole proprietorship. And so sometimes it's hard to attract good employees when you're a small business operating as a sole proprietorship. Sole proprietors, because they are one owner, they are the business, often will spend significant amount of time working the business. They may end up working 12, 14 hours a day, 7 days a week, and really may not have the opportunity to leave business at the office. It's a huge personal time commitment, and because there may not be anybody to share the responsibilities in operating the business, which can create some issues in managing your work life or work and personal life balance. Another disadvantage of the sole proprietorship is that it has a finite business life. When the owner or the sole proprietorship dies, the business ceases to exist. So it does have a sole proprietorship does have a finite business life. And again, as I mentioned before, the sole proprietor is really responsible for all the losses of the business as well. Although when you file personal income tax, some of those losses can be deducted from other sources of personal income. The second type of business organization is called a partnership. And a partnership really is an association of two or more individuals who agree to operate a business together to generate a profit. In Canada, there's three primary forms of partnerships. The first and the simplest is what's called a general partnership. In a general partnership, each of the partners fully participates in managing and operating the business together. They make decisions together, and partners share, not necessarily equally, but they will share in both management responsibilities as well as the profits of the business. In a general partnership, each of the partners have full liability for any of the debts or liabilities incurred by the partnership, by each of the other partners as well. So each partner in a general partnership really is acting on behalf of the business. And if one of the partners signs a contract and on behalf of the partnership, each of the other general partners is fully liable for that debt or for that liability as well. It is, however, the simplest and a very common form of partnership in Canada. Many small businesses might operate as partnerships. A lot of farms our smaller farms in Canada operates as a general partnership between spouses, for example. The second form of partnership is what's called a limited partnership. And in a limited partnership, there are two types of partners. One is a general partner, who is the person that is responsible for managing and operating the business. And the general partner is fully liable for all the debts of the partnership. There may be one or more limited partners in a limited partnership. Those limited partners cannot participate in the management of the business. So they contribute capital, they contribute money or investment into the partnership, but they do not participate in the management of the business or making operating decisions of the business. In return for that, a limited partner's liability is limited to the amount that they have invested into the partnership. So if the limited partnership is not successful and closes, the most that the limited partners could stand to lose is the amount of their investment, whatever they put into the business. They're not liable for anything more. However, the general partner is liable for all debts of the partnership. The third type of partnership in Canada is something that's called a limited liability partnership, or an LLP. And in a limited liability partnership, each of the partners is protected from the acts of the other partners. So in a limited liability partnership, if and we often see this in professional practices, if one of the partners is sued for malpractice, for instance, that partner may be that partner that's being sued would certainly be liable for the liability, but the other partners are protected from the actions of other partners in the limited liability partnership. So the limited liability partnerships, they are common in Canada, and they came about in the late 1990s, I guess. So they're a relatively new form of partnership, and they're very common for professionals such as accountants or perhaps lawyers. So overall, partnerships are, again, a common form of business organization in Canada, and they are still relatively easy to set up. Basically, the partners agree, either orally or in writing to join together to operate a business, and they perhaps register their partnership name with the government, and they're off and running. So it is fairly easy to set up and form a partnership in Canada. One of the advantages of a partnership is, of course, you have more individuals bringing capital or investment into the business, so have some additional access to capital if the business is looking to expand, as well as in a partnership, you're bringing in some skill sets and additional management abilities and assistance in operating the day-to-day affairs of the business. So you can bring in a diversity of skills and expertise. Really important when having a partnership to bring in people with, or other partners with different skills. Some may be stronger in marketing, some may be stronger in accounting, others may be strong in human resource management, for example. And so you can bring in other partners that have an equal, perhaps, in interest in the success of the business. Another advantage of a partnership is that there's no special taxation as well. Each, very much like a sole proprietorship, the profits of the partnership are split between the individual partners, and each of those individual partners will include the amount of income generated from the partnership as part of their personal tax return. So again, taxation is at personal tax rates, and they may achieve some of the tax benefits from being taxed at personal tax rates as opposed to corporate income tax rates. There's not a lot of special regulations and that sort of thing that exists for corporations for a partnership as well, so that can be a benefit as well. The flexibility advantage, listing your textbook, it says that general partners are, because they're actively involved in managing the business, they can respond fairly quickly to changes in the business environments. So again, partnerships tend to be a little bit smaller in terms of business size, more responsive to changes in the business environments. There are, however, some disadvantages of a partnership. One being, at least in a general partnership, is the concept of unlimited liability. So each of the general partners is fully responsible for all the debts of the partnership. In a limited liability partnership, there is still at least one general partner. There can be more, but at least one general partner who is responsible or has unlimited liability as well. Oftentimes in a partnership, because there are more than one owner, there's often conflict, whether that's a marital breakdown in some small husband-wife type partnerships, or partners having different visions and want to take the business in different directions. Oftentimes there is the potential for conflict, and once conflict creeps into a business, it can be very difficult to manage and can lead to the failure of that business. There may be disagreements on sharing of profits, for example. How do you divide up the profits in the business? It's not necessarily, it doesn't have to be done equally. So in a partnership, you need to decide upfront how you will be sharing those profits. To exit or close a partnership, it can be a little bit more difficult when one partner wants to leave. Basically the partnership needs to value all the assets of the business and the liabilities to determine the value of that leaving part, or the exiting partner's interest. And who will that interest be sold to? Will you bring in another partner? Will you pay out the partner who decides to leave or retire or whatever? So there can be more complexity in dissolving a partnership. So some of these disadvantages can be overcome by having a clearly defined and preferably written partnership agreement up front. That should address some of these issues. So on the next slide, we'll take a look at some of the things that should be included in a partnership agreement.
As we said, it's important when entering into a partnership that there is a written partnership agreement. In fact, if you are looking at business, I would strongly encourage you to seek some legal counsel in creating a partnership agreement, because they can vary. They can be sometimes they can be very simple. Oftentimes they are very complex, especially as the number of partners increases. Some of the things to include in the partnership agreement include, the name and the purpose of the business, where it's going to be located, the names and addresses of all the partners. Partners should be indicated in that partnership agreement when it's starting, as well as what the financial contributions of each of the partners are. How much money are they required to invest and perhaps keep in the business? Partnership agreement should outline the duties and responsibilities for each of the partners to avoid some of the conflicts that may arise later on. Partnership agreement should indicate whether the partners are going to be paid some salaries and what those salaries are, and how the draws of the partnership. And a draw is when a partner withdraws money from the partnership. So the partnership agreement should specify how those draws are to be handled, who has to approve them, are there caps on amounts, etc. Partnership agreement should clearly indicate how the profits of the business, and consequently the losses of that business, are going to be shared amongst the partners. In the absence of anything in a partnership agreement, the law assumes that all the profits and losses will be shared equally, and that may not be the case or your intent. It should outline the accounting processes that are going to be followed, particularly whether financial statements will be audited or prepared by an accountant, etc. Partnership agreement should outline the provisions for changes in partners. If one partner wants out of the partnership, or if one partner dies, what is the process for continuing on in the business? Oftentimes there may be some detailed valuation processes to determine the amount that has to be paid to the leaving partner or a deceased partner's estate. But clearly the procedures for handling any changes or death of partners must be clearly indicated in that partnership agreement. Good partnership agreement will also provide provisions for resolving disputes, how those disputes will be handled, or if need be, whether a third-party arbitrator will come in, and who that might be to help the business avoid disruption or avoid disintegration because of some significant disputes in the partnership. So there should be some mechanisms outlined on how to handle those disputes in the partnership. And again, valuation of the partnership, and how are you going to dissolve the partnership should the partners agree to cease carrying on business. What will be the process to value the assets and split the proceeds of all the assets?
Individual partners. What will the withdrawals be for each of the individual partners? And how will profits or losses be shared? Who's going to be doing the accounting? Will you have an external accounting firm? Will your books be audited? Any restrictions or rights of and duties of each of the individual members? What will you do if there is a conflict or disagreement in the partnership that can't be resolved? Will there be a provision in the partnership agreement to hire an external mediator to help resolve any conflicts that can't be resolved by the partners themselves. How will you dissolve the partnership? How will you come to an agreement to close the partnership? If one partner is not happy and wants to leave and start out business on their own, how will you prevent them from taking your client list or competing with you? So there's a lot of things to consider up front before starting a partnership, and I would strongly encourage you to seek legal counsel in the provision and preparation of a partnership agreement. The third primary form of business organization in Canada is called a corporation. And a corporation is very different from either a partnership or a sole proprietorship in that a corporation becomes a legal entity unto itself. It essentially becomes a separate person in the eyes of the law. So it has its separate existence, it has a separate lifespan apart from the owners. And in a corporation, the owners are completely separated from the business with respect to liability. So a corporation can make decisions on its own. For instance, a corporation being a legal entity or can enter into contracts on its own, and the owners are not personally liable for the debts of the corporation. So there's a complete separation of ownership and legal liability from the owners and the corporation. So oftentimes when we think about corporations, we think about large corporations. These are the ones we hear about in the news all the time, and there are some very large corporations. Here's a list for 2012 of some of Canada's largest corporations, that have huge revenue bases, and you're probably familiar with most of these. However, there are many small corporations in Canada as well. As we saw, about 70% of businesses in Canada are corporations, and many of those are small corporations that may have one owner or a limited number of owners in Canada. So I want to talk about the two primary forms of corporations in Canada. The first is a public corporation. So keep in mind, ownership or investors of a corporation are completely separate from the business itself, from the corporation itself. To become a corporation, a business needs to register the corporation and receive something that's called the Articles of Incorporation. Think of it as a birth certificate identifying the creation of this new legal entity. So that is done through the government by applying for a corporation. And lawyers will typically assist clients in creating a new corporation in Canada. Just for your information, in Canada, when you are incorporated, your name must identify as being a corporation. So you'll see most corporations have the words limited in them, in the corporate name, or LTD or limité in French, or corporation or incorporated, something that tells the public that it is a corporation. In a public corporation, the shares are what the owners own, and the shares represent ownership of a corporation. So as an investor, if I own a share of a corporation, that is the document or the piece of paper that represents my ownership. So in a public corporation, the shares are widely held and they're available to the general public. Most of the shares of a public corporation will trade, for instance, on one of the recognized stock exchanges, the Toronto Stock Exchange or on the over-the-counter market. They don't all have to trade. All shares of a public corporation don't have to trade on the market, but many of the larger corporations do. So investors can buy and sell the shares separately without involvement of the corporation on the open market. So when you think of the larger corporations in Canada, most of those will be public corporations that can have millions of shareholders, millions of owners. When you own shares of a corporation, you in fact are a shareholder or an owner. And you're entitled to receive dividends or participate in the price appreciation of those shares. The second type of corporation in Canada is called a private corporation. And so in a private corporation, the shares are not publicly traded. So anybody can't become an owner of the private corporation. Many small businesses in Canada are in fact private corporations. They have a smaller number of shareholders. Generally in a private corporation, the number of shareholders is limited to 50. And there are restrictions on transferring ownership. You can't necessarily just sell to anybody in a private corporation. So today I'm seeing a lot of farms that perhaps have been operated as partnerships being set up as a corporation, and in fact a private corporation where the husband and the wife and perhaps children may own shares of the farm corporation. And that can apply to any of the small and medium-sized businesses that we see in Canada. Many corporations in Canada start out as private corporations, and as they grow, they may become public corporations or open up the ownership to the general public. And that is done, and that's called going public. So a private corporation that opens up its ownership to the general public goes public. And it's really a very complicated and very expensive process to go through. Basically, there's a lot of legal work and prospectuses that are created, and what the private corporation does is initiate an IPO or an initial public offering, and they work with an investment banker to create shares and issue them for sale to the general public, often on one of the public stock markets. Very controlled. It's controlled by either provincial or federal securities commissions, lots of regulations involved, and it's a very, very expensive process for a private corporation to go public. The incorporation process itself, as I said, involves a little bit more steps and is usually done by a lawyer. One of the first things to do is to search to make sure that the corporate name is available. Think of it just as giving your kid a name, because a corporation is a separate legal entity in the eyes of the law. It has its own name. So first step is make sure nobody else has that name. And many corporations start out as numbered companies. They haven't defined a name yet, but they want to start the incorporation process. So you'll see a number of corporations that are called 1, 2, 3, 4, 5, 6 Manitoba Limited, for instance, or 7, 8, 9, 10, 11, 12 Canada Corporation. You can incorporate either provincially under provincial legislation, or under the Canada Business Corporations Act as a federal incorporation. So both the provinces and the federal government have acts for incorporating companies. Generally, where you incorporate, either federally or provincially, is based on where you do business. If you're going to do business right across Canada, it may be wise to incorporate under the Canada Business Corporations Act versus the Manitoba Corporations Act, and then you will need to follow all of the federal laws versus the provincial laws, because each of the provinces do have differences in the provincial legislation. So once you've checked the names available, you will create what's called, or apply for, articles of incorporation. And the articles of incorporation will generally specify the name of the company, the province in which it will be registered, and where the head office will be. It'll discuss and authorize the types of shares that can be issued and the numbers of shares that can be issued. And we've seen that there are different types of shares: preferred shares, common shares, convertible shares, etc. So the articles of incorporation, or the birth certificate of the corporation, will dictate what what types and number of shares that the company can authorize. If there's any restrictions on the transfer of ownership, that would be outlined in the Articles of Incorporation. And the Articles of Incorporation will also outline the number of directors, or a minimum or maximum number of directors that the corporation will have, and any restrictions on the type of business that the corporation may enter into. So it can be a lengthy document. Some of them in small private corporations are fairly simple and straightforward, but it must contain those minimum requirements. Once the articles of incorporation are sent, they're approved by the government, pay some fees, and then the articles of incorporation are registered, and the business exists. It's given new life. And then one of the first things that will be done is the business will, of course, appoint some directors and start creating bylaws and making decisions, and start operating the business. So a corporation is really a unique form of business organization. As we said, it is a separate entity, a separate legal entity in the eyes of the law. It becomes a separate person, if you will, in the eyes of the law. And of course, that person can make decisions on their own. However, for a corporation to make decisions, it must be managed and governed by individuals. Typically, in a corporation at the highest level, we will have a board of directors. And these are the ones that are ultimately accountable for the operations of the business. So all the shareholders will elect members to the board of directors, and the board in turn will hire senior management to operate the company on behalf of the board for the benefit of the shareholders. So the board of directors will typically hire and appoint a president of the company, perhaps vice presidents, treasurers, secretaries, and a whole bunch of functional executive in a corporation as well. So the shareholders elect a board of directors, and the board of directors appoints the top management, or the senior level, executive levels of management in the firm. And so the board of directors, as well as the top management, really become the brains of the company, because remember, this legal entity doesn't have a mind of its own. So the board of directors, as well as the executive, really become the brains behind the corporation, or the separate legal entity. There are many advantages and disadvantages with incorporation. Of course, the biggest advantage is the limited liability. So shareholders do not have liability for any of the decisions or the debts of the corporation. That doesn't mean that they can't lose money, because if the corporation fails and closes, the shareholders can lose the amount of the investment that they have invested into the corporation. For corporations, particularly for public corporations, it's very easy to transfer ownership. Me, I own shares of the Bank of Montreal. If I decide I no longer want to be a shareholder or owner of the Bank of Montreal, I can take my shares to a stockbroker and say sell them for me, and transfer my ownership to someone else in return for hopefully a profit if the share prices have gone up. Corporation is different from a partnership and a corporation because it has unlimited life. So if one of the shareholders of the corporation dies, the corporation continues to exist. There's no effect on the life of a corporation with the death or transfer of ownership between shareholders. Corporations typically have access to higher amounts of capital, and that makes them more attractive to lenders to lend them money. Typically a corporation, particularly private in a public corporation, have access to a lot more capital, and so they can. It's easier for banks to lend money sometimes to a corporation, particularly a larger corporation. As well, corporations have the ability to sell more shares to attract some additional capital or ownership or equity interest. Corporations, because they tend to be larger, and they often will have better benefit plan for employees and better opportunities, more management positions. So it makes them more attractive to potential employees. So when you graduate, you may be thinking of working for a corporation, a well-known corporation that you know, because of some of those things, because of the benefits and that sort of thing that exist. There are some disadvantages of corporations. One we've talked a little bit about, and that's the cost and complexity of formation. As well, there are a lot more regulations and controls for corporations. For instance, corporations typically have to produce financial statements for the shareholders, and if it's a public corporation, those financial statements need to be audited, which can be expensive. The Securities Exchange Commission really monitors and controls corporations. There's a lot more filings that need to be done with the government for corporations. Whereas sole proprietorships and partnerships will file a personal income tax return, corporations must file a different form of corporation tax, which is more complicated, often involves more expertise in the preparation of a corporate income tax filing. One of the disadvantages of a corporation is, unlike for partnerships and sole proprietorships, if the business loses money, the individuals that own the corporation or the shareholders cannot offset the business losses against other forms of personal income. So that can sometimes be a disadvantage, particularly for small, privately held corporations. One of the biggest disadvantages of corporations is the fact that there's double taxation of profits. So to understand that, remember that a corporation is a separate legal entity in the eyes of the law. It generates profits for the business. It may decide to the business generates profits, and it pays income tax on the profits that is generated at corporate income tax rates, which often are higher than personal income tax rates. Okay, so the profits are taxed in the hand of the corporation. Then the corporation may decide to distribute some of the profits to the owners or the shareholders in the form of dividends. So dividends, the board of directors meets and they decide that we are going to return some of the profits back to our investors, our shareholders, and they declare a dividend of, let's say, $1 per share. For every share that an owner or investor, shareholder has, that they will earn $1 for each share. Those are what we call dividends. And those dividend payments that go to the investors are paid by the corporation out of after-tax profits. And once the investor gets that dividend check in the mail, they need to include that in their personal income tax return as another source of income, and then they are taxed at personal income tax rates on the dividend that they received from the corporation. So in essence, we have double taxation. The corporation is taxed at corporate income tax rates, and then the individual, the shareholder, is taxed on any dividends received at their personal income tax rates. So that's been one of the biggest disadvantages of corporations. So to lessen the effects of this double taxation disadvantage, the government of Canada has initiated something that's called a dividend tax credit. So for the shareholders, so they would include the dividend in their income, but they would also be eligible for what's called a dividend tax credit. And how that works is really beyond the scope of the course, but it's really intended to lessen the effects of double taxation. Important to note that in Canada, in the Tax Act, there's another type of corporation, or a special type of corporation, called a Canadian-controlled private corporation. Canadian-controlled private corporations are private corporations. They're closely held, under 50 shareholders, and ownership is entirely Canadian. These are typically smaller businesses, such that, and they do have some tax advantages under the Canadian Tax Act, because the first, I think it's $500,000 of income for a Canadian-controlled private corporation is taxed at a lower rate. So again, another measure to try and counter this effect of double taxation of profits for corporations through the Income Tax Act in Canada. In Canada, there's also another type of corporation. And your textbook calls it a one-person corporation, or it's a limited liability corporation, really. And it's a type of corporation that only has one shareholder, so there's only one owner. And it's very common in the medical or professional industries. For instance, many doctors may incorporate their medical practice, or many accountants or lawyers will incorporate their legal practice or accounting practices as well. So they're very small corporations. They're really one owner in the corporation as well. There's another form of a corporation that you should be familiar with. I think we talked a little bit about this in Chapter 17. It's a Crown Corporation. A Crown Corporation is a corporation that's owned by either the federal or provincial governments. So, for instance, in Manitoba, the Manitoba Liquor Control Commission would be an example of a Crown Corporation. So it's owned by the provincial government. MPIC would be a Crown Corporation as well. And at a federal level, CBC would be a Crown Corporation. And it is owned really by one level of government or not. And they are essentially designed to perform some, regulatory function or advisory function, or some sort of special services to Canadians throughout Canada. But they are a special form of corporations that are owned by a level of government. Another special form of business organization in Canada is the cooperative, or you may know them as co-ops. And they are really legal entities that are formed by people that have a common interest, and usually for a purpose of reducing costs or providing a service to the members of that cooperative, sometimes to gain economic power. In Canada, there's about 9,000 cooperatives or credit unions, which are really just a financial cooperative in Canada, and they play a big part in the Canadian economy as well. But there are some differences between cooperatives or between cooperatives and corporations in three primary areas. The first is the purpose of a cooperative. So the primary purpose of a cooperative is to meet the needs of the members, whatever the cooperative is designed to do, to really meet the needs of the members, whether it be to gain bargaining power or to reduce costs or provide financial services to the membership base, rather than maximizing the value of the company, which is the common business objective for other forms of business organization. So the purpose typically differs from other forms of businesses in Canada. The second is the control structure. So in most businesses, the control structure, or in a corporation for instance, in a corporation, each share entitles the shareholder to one vote. So in a corporation, you can have majority shareholders who really control the board of directors or control the corporation. Whereas in a cooperative, each member gets one vote. So there is no differentiation between ownership interest in a cooperative, unlike a corporation. The third differentiating characteristic of a cooperative from other forms of business organization is the allocation of profit. So whereas in a corporation, if I own 50% of the shares of a corporation, I'm entitled to 50% of the dividends that would be paid by the corporation. However, in a cooperative, usually the financial payback, or the allocation of profits, comes in the form of dividends, a special dividend often called a patronage dividend, to the members. But the amount of that dividend is based on how much business that member did with the cooperative, as opposed to their ownership interest, because in a cooperative each member has the same ownership interest. So some of you may be members of a credit union or a cooperative such as Red River Co-op, and based on the amount of business that you've done with them, at the end of the year you may get a patronage dividend based on the amount of business that you've done with that cooperative. So the allocation of profits differs for a cooperative than a regular business entity. There are some very large cooperatives, as we see in Manitoba. The Mountain Equipment Co-op that you see on the slide here is a cooperative for members. So you must have a membership interest to become a member of that cooperative. Many of you may be members of a credit union or Red River Co-op, or any type of cooperative in Canada. Another form of business organization in Canada is something that's called a joint venture. And a joint venture is different from other forms of business in that they're really not a separate legal entity. All they are is an agreement between two or more companies that agree to pursue a particular specific business activity or a specific project for a certain period of time. And so they may combine forces to develop a new initiative or develop a new product. And once the purpose, or once that product's developed, and it may close, that agreement or alliance will end. There are some very large joint ventures, such as Syncrude Canada, and there are various companies that have formed a joint venture with the purpose of exploring the oil sands and that sort of thing in Canada. And so there's a large number of companies, separate corporations, that have formed together for that special purpose. In Manitoba, I see a lot of joint ventures between farms. So farmers, for instance, potato farms, may form a joint venture, and that of different potato farms that are all incorporated, and they will form a joint venture for the purpose of building, for instance, storage facilities to house the potatoes in. And so each of them would contribute certain capital and expertise into the joint venture to operate this potato storage facilities. So joint ventures, again, are common, but again, they're not really a separate entity in the eyes of the law.
Another form of business organization is something that's called direct selling. And direct selling is a marketing structure that connects the sellers directly with customers. For instance, many of you may have operated Amway businesses, or Avon, sold Avon as a direct seller on behalf of Avon Canada, for instance. So there's a lot of these that are smaller businesses that deal directly with customers.
So let's take a look at the concept of mergers and acquisitions, or M&A as it's commonly called. First of all, to explain the difference between a merger and acquisition, in a merger, two or more companies, usually probably roughly the same size, will combine together to form a new company. They take on a new corporate entity. So Company A, Company B merge together and form a new entity we'll call Company C. And that's a little bit different from an acquisition, because in an acquisition, the one company, Company A for instance, will purchase all or the majority of the shares of Company B, and so Company B becomes owned by Company A. Each company maintains their separate existence in the eyes of the law, their separate legal structure, and Company B becomes what we call a subsidiary of the parent company, which would be Company A. Sometimes an acquisition is done friendly. There's a healthy negotiation between the purchasing company or purchase company and the acquiring company, and that's something we call a friendly takeover. So it's really being supported by the management and the board of directors of Company B, which is the company that's being acquired. However, sometimes we'll see a hostile takeover where the company that's being taken over does not want to lose control. However, Company A, which is the acquirer, will go to the markets, purchase shares of the Company B, and essentially gain control of it. There's all sorts of different reasons that companies will look towards merger acquisition. Some of the obvious ones are to grow, which is a common theme, just to be able to grow, increase their market share, and hopefully increase their profitability. Sometimes mergers and acquisitions will happen to become more efficient, to eliminate some waste, to gain some synergies, and therefore increase their profitability for the shareholders. Sometimes mergers happen because or an acquisition will happen because the one company may have something the other company wants. Perhaps the one company is really good in technology, and that's lacking in company A, for instance. So they will look to gain the control of that technology or perhaps product or service that they deliver that they wouldn't be able to provide on their own. Sometimes mergers and acquisitions happen as part of a financial restructuring. So to be able to cut off costs, sell off units, lay off employees, particularly if one of the two, or if the acquired company is having perhaps some financial difficulties. Sometimes a merger and acquisition might happen to reduce risk. For instance, a company that's in one industry might acquire other companies in other industries to be able to spread out their risk and become more attractive to investors. So there's always, the headlines always splash the big mergers and acquisitions. We've heard of, Microsoft recently buying Nokia handset services for, $7 billion a few years ago. Google bought Motorola for just under $10 billion. Microsoft purchasing Skype for $8.5 billion or so. But it also happens with smaller companies as well, where there is either a merger or a downright acquisition of another company. There are different types of mergers and acquisitions that you should be familiar with. First of all, a horizontal merger or acquisition is when companies come together that are in the same stage of the supply chain, in the same industry. And usually that's done to reduce costs or expand product offerings, reduce competition, perhaps. So that could be where one auto manufacturer purchases another auto manufacturer. So they're really in the same industry, at the same stage of production. A vertical merger, a vertical acquisition is where two companies that are in the same industry combine forces or come together either through a merger or an acquisition. But they're at different stages of production. For instance, if GM bought one of its suppliers of goods and services that go into the production of cars, that would be an example of a vertical merger. Or if Pepsi bought a sugar processing plant. So they're in the same industry, but in different stages of production. Often that's done to gain control of a supplier, for instance, to ensure that they've got more control over that supplier and assured supply. They can manage the quality of the supply if it's a critical input into the production process, for example. A conglomerate merger is when businesses come together or are acquired in different industries. So a bank might buy a stock brokerage firm or an insurance company and merge or be a subsidiary. And that's often done to reduce risk for shareholders by spreading out the risk into different industries. A leverage buyout is a form of corporate finance where it's really it's corporate takeover, rather, which is really financed by large amounts of debt. So it can be done, financed externally or financed internally somehow by the company to take over another corporation. That was fairly popular, I don't know, in the 1980s or so. not such a successful strategy, so we didn't see a lot of continued growth in leverage buyouts, and they found that the returns often weren't as they expected. Franchising has certainly become one of the more popular ways of getting into business, and for many businesses in Canada. And franchising is really a form of business organization where there's a business arrangement between a franchisor, that's the big guy, the head guy, or the head business, which supplies a product concept. Kind of it supplies a business in the box concept to a franchisee, and the franchisee then is licensed to sell the products of the franchisor, usually in a certain geographic area. There are many franchises operating in Canada and the United States. They're very popular, the largest of which is, of course, McDonald's, which has over 31,000 franchisees. They have 31,000 restaurants in about 119 companies. 70% of those are owned by franchisees. The other 30% would be what we would call corporate stores and actually managed by the franchisor. So in a franchise, the franchisor will provide an agreement with the franchisee in exchange for a price that we call a franchise fee. A franchise agreement. And a franchise agreement really is a contract between the franchisor and the franchisee. Outlines all the responsibilities, all the things that the franchisor will provide, and also outlines all the rules that the franchisee must abide by. And a franchise agreement usually covers a certain period of time, so it's not forever. Usually 20 years, maybe 30 years, with options to renew. Some of the things that the franchisor might provide might be the operating structure. They might provide the training. They obviously will provide the products and business processes that are to be used by the franchisee. Good franchisors often provide training, management support, accounting services, shared marketing programs for each of the franchisees as well. Under the franchise agreement, the franchisee also gets to use the trade symbol and trademarks, logos, and of course use the name of the franchisor. So it's a very popular way to get into business, and with all the supports, often is lower risk, but not a guarantee. There's no guarantee of success with when you buy a franchise. I've seen lots of franchises. In fact, I finance lots of franchises that have not been successful, and many of which, or most of which, are not around any longer in the Winnipeg market. So it's certainly not a guarantee. This slide just shows some of the top U.S. franchisors that were looking to expand throughout 2012, and some of the startup costs involved. In Canada, Subway over the last few years has been one of, if not the fastest growing franchises in Canada. Important to take a look at the startup costs. Usually, to get into a franchise, you need to pay a franchise fee, which is an upfront fee to the franchisor. And often there are royalty payments that the franchisee has to pay to the franchisor as well. For instance, the franchisee might have to pay 2% of sales to the franchise, or as an ongoing cost. So there's not just the upfront franchise fee, but an ongoing royalty fee that is often paid by the franchisee to the franchisor. It's interesting to take a look at some of the expectations for startup. For instance, McDonald's really takes over $1 million, $1 to $2 million to start up a McDonald's franchise. For instance, if you were looking at, in Canada, setting up a Tim Hortons business, I believe the expectation is that you've got about $250,000 of unencumbered cash before they'll consider you as a franchisee. Just because you want to become a franchisee doesn't mean that you will become one. There's a rigorous process to go through to apply, because it's important for the franchisor that they only get people operating their franchises, because they're giving them the license and reputation and everything. So they want to ensure that they've got the right people acting as franchisees and selling their products and services in the marketplace. So let's take a look at some of the advantages and disadvantages, and these are from the viewpoint of the franchisee. First of all, so from the franchisee's perspective, when they buy a franchise, they're getting a trusted business, usually a recognized name, an operating concept that has been proven. They've got a supply of product, operating procedures, which is a great advances. They're getting a business in the box. That may include premises. That may include assistance in locating premises, etc. Often franchisors will provide management training, assistance, guidance, and mentorship throughout the term of the franchise agreement, which can be a huge advantage for many franchisees. Many franchisors will also provide financial assistance, either directly from the franchisor or through some arrangements with a chartered bank in Canada. At BMO, we've got lots of what we call franchise packages that kind of outline the requirements and the financial package, loans, deposit services that have been negotiated with the franchisor that will be provided to the franchisees. So sometimes it's easier to get financing for a well-respected, well-known, reputable franchise. So there are lots of advantages from the perspective of the franchisee. There are some disadvantages, however. So not only is there a franchise fee, which can be hefty, paid up front, but there is usually a royalty payment that is paid on a regular basis to the franchisor. So there is a significant cost to franchising. Franchisees also must respect all the decisions and operating procedures of the franchisor. For instance, if I buy a McDonald's franchise in Winnipeg, I can't decide to all of a sudden adding beer or wine to the menu because I would not have that flexibility. Typically, so I don't have control on offering new products unless they are sponsored by the franchisor. So there is some loss of control in acting as a franchisee, and I will often always have to follow their specific procedures in operating that franchise. So that can be a disadvantage as well. So it's something to consider if you're looking at getting into business and have some money to get into business. Franchising can be a popular way of doing that. So with respect to business ownership, what do we expect going forward? We certainly expect to see more mergers and acquisitions as companies are looking to aggressively expand, either in domestic countries or in foreign countries as well. So we'll see a lot more merger talk. In all industries, both large and small. So we can expect to see more of that in the future going forward. Keep in mind there's some demographic shifts as well, as with the baby boomers retiring. What's happening right now is this giving lots of opportunity to buy existing businesses. So many baby boomers are looking to retire. So there's a trend towards more businesses for sale in the market. So if you're looking at getting into business, might be good to talk with accountants and lawyers who may know of entrepreneurs that are looking at selling, because there's certainly a shift or a retirement of many baby boomers that is happening, and we'll start to see a lot more innovations in the franchise world. There's a lot of doubling up of franchises. For instance, we see the Tim Hortons, Wendy's combining of forces to operate to share joint premises and that sort of thing. So we start to see some mini franchises being set up. For instance, Tim Hortons and some of the gas stations and that sort of thing. So a lot more innovations and concepts and even new ideas. If you go to one of the franchising sites, just search franchising in Canada in Google, you can see there's lots of up and coming new franchisors that are looking to expand. So lots of things happening in the market or in the business world today with respect to business ownership. This is a good place to go if you're looking for some information on starting up a business. Canada Business is a website, and you can copy down the URL there and go. There's lots of information on the different forms of business organization and franchising, and what you need to do for licensing, and how to go about getting set up, how to incorporate, some of the considerations to think about if you're looking at starting up a business in Canada. So bookmark that site, Google it, bookmark it, and come back there often when you're ready to start your own business.